Welcome to the Empowered Investor Podcast, brought to you by the advisory team at Toulette Matthews and Associates. Have you ever felt overwhelmed by the number of voices telling you how to plan or invest for your future? We're here to help you cut through the noise, bringing clarity to your investment decisions and helping you build lasting financial peace of mind. Learn more and subscribe today at tma-invest.com. Welcome to the Empowered Investor. My name is Keith Matthews, and today I'm joined by my co-host, Jackson Matthews. Jackson, it's so great to have you on today's show.
Thank you. It's good to be here.
This is episode 126, and this is, Jackson, our first episode together as father-son.
Yeah.
Fantastic to have you in today's show. You've done a lot of episodes with Marcelo and Lawrence. Today's a big topic. We're talking about implications for investing through the Middle East conflict that we're currently dealing with. Before we get into today's content, tell us a little bit about your role, what you do at the firm, and how you help clients.
Yeah, so I've been here I'm going into my 6th year, and I'm an associate portfolio manager. I've been working directly with clients for about 3 years now, and it's an excellent group of clients I've been working with. So I take care of their portfolio management, I assist them with their financial projections, I help the tax team here, and more.
Yeah, it's a fully comprehensive set of services. I personally trained you, as I did with many of the other advisors, and it's fantastic to have a family member in the business. We have 15 individuals in our firm, and you're thriving, you're doing super well. I'm excited that we're doing our first podcast together. It is a difficult subject today in the sense that we're dealing with how to manage money, how to manage portfolios through conflict. Conflicts are never easy. It seems like we've had a few conflicts in the last, I'd say, 4 or 5 years with regards to Russia and Ukraine, the Gaza conflict, and now we're dealing with the Middle East conflict as we approach the end of March. Lots of human suffering throughout all these, and we never like to see that. Of course, having said that, our responsibility is to make sure we can help investors navigate through these difficult periods. And so that's really what today's purpose is for this podcast.
Yep.
We've had a lot of headlines, a lot of uncertainty. So we're now in the 3rd week of March. And we're going to put our investment management lens on everything that's going on and share with our listeners today the specifics about exactly kind of the implications of the war, the implications on the market, and talk about how the market's doing, and then really bring in evidence around what's happened in previous wars, how have markets reacted in earlier periods of difficulties, and then what are the do's and don'ts that investors should do.
Yeah, exactly. And to add on that, we're not here to predict outcomes or speculate on any geopolitics. We're really here to talk about our investment philosophy and how we think of investing as a firm. And we're here to help investors stay grounded and disciplined in their long-term approach to investing.
Absolutely. I mean, part of the investment philosophy that we subscribe to is very much a long-term investment approach. It's worked out super well for, I think, all of our clients and those that around the world that embrace this approach. So let's jump into the context of where we're at right now. So we are approaching the end of Q1, Jackson.
Yeah.
Give us a bit of a review in terms of really what's happened since January right up to today.
Yeah, so obviously, as most investor knows, 2025 was an excellent year in the global markets, and the first quarter of 2026 continued with that momentum. It continued to advance in January and February, driven by, resilient corporate earnings, moderating inflation in several major economies, and, the ongoing technology and AI investment cycle. We've really experienced what they call a bull market, but this quarter has really been 2 distinct halves. So, I just spoke about the rally, but now we're seeing a little bit of market correction based on, the ongoing conflicts that have occurred over, the last couple of years. However, now with this new conflict with Iran, it's really eroded some of the meaningful gains that we've had in the first quarter.
Yeah, I think we've lost probably 80% of the market gains. Surprisingly, though, our diversified portfolios are still slightly positive year to date, including the recent sort of corrections, if you will.
Yeah, exactly.
So up until the high of the year, our portfolios were up, equity portfolios were up about 8%, and which value was doing better and small was doing better than broad. So our portfolios were doing slightly better than benchmarks. And then obviously in the last month, We've seen a complete erosion of those returns and a lot more volatility. So, Jackson, what are some of from peak to trough, from the high point to where we're at as of yesterday?
Yeah.
What are some of the declines we've seen in some of the major benchmarks?
Yeah, so the S&P TSX Composite, so the Canadian broad market, has been peak to trough down 7.7%. The S&P 500, which is the US market, is down 6.2%. The MSCI EFI, which is the international market, is down 8.5%, and the MSCI emerging market, which covers, obviously the emerging markets, is down 8.1%. And then, of course, we did a podcast a couple weeks ago about gold, and speaking about its valuation and its massive run up in the markets, that is down 12% peak to trough.
And the irony on gold, of course, is that gold is often, and we did that podcast 3 weeks ago saying, be very careful, don't overexpose, have market weight to gold. And of course, gold is known as a safe haven, but it's actually not acting as a safe haven right now, and it's actually off more than broad markets. Ironically, the US market is probably off the least relative to Canada and Europe and Asia. However, the non-US assets have done incredibly well in the last year, including the first 2 months of this year.
Yeah.
So it's just a bit of rebalancing going on there.
Exactly.
We don't believe in any type of rotation in portfolios, so we won't look at that. But we'll touch base on that more on the end of today's show when we discuss sort of what we feel are the right ways to manage money long term.
Yeah.
So let's jump into why markets are reacting. What's going on here?
Yeah. So obviously there's, it's hard to pinpoint one exact reason why markets might react negatively to certain conflicts. But in this case scenario, it's really been oil prices and inflation fears, and I'll explain a little bit more about that. So what's happening in the Middle Eastern Iran conflict right now is the Hormuz Strait has effectively been shut down and completely halted all of its flow through of oil. And so this strait it's unique in the sense that 20% of the global oil passes through that strait on a yearly basis. And so, the countries like UAE, Kuwait, Iran, Saudi Arabia, all these countries are massive oil producers, and their oil passes through this strait. And the reason why now it's essentially shut down and it's created this massive bottleneck. And so really we're experiencing a little bit of an oil crisis, and there's definitely been shocks to the markets. And the implications are more towards, Europe will feel it more, and so will Asia, specifically China. But essentially why this plays into inflation fears is because everything from manufacturing to transportation of goods, food costs, it's all associated to oil. And so this can push up inflation, and that's why investors fear that inflation might go up.
There's a lot going on here, so let's take our time and go through a few things. What I find interesting is looking at a BCA report that I reviewed prior to this podcast. It reminded me that the Middle East has a GDP, represents about 4% of GDP, the region that's in conflict right now. So it's really very, very small.
4% of global GDP?
4% of global GDP, correct. However, it's got a much greater impact on the passage of oil. And this is, like you said, really at the crux of why markets are agitated, more so than a traditional conflict, if you will. So one of the things I would add is that, while the U.S. and Israel are aggressively attacking Iran, Iran is using a little bit of an economic war. They're trying to put pressure on the entire world right now. Of course, it seems to be working a little bit for now.
Yeah.
But that's sort of a slightly different feel. And every time we see conflict, and we'll review some of these in the past, people will always say, but I've never seen this before. This is a different type of conflict. And I think that's totally normal, because all these different issues, these geopolitical risks, conflicts, they all have their very unique flavors. And so this one here definitely has a unique flavor to it, and it's different. But that doesn't mean we should react differently around that. We'll talk about that as we get later into today's episode. What's really at stake here, Jackson? What is sort of the trickle effect here?
Yeah, so there is some larger implications here. So as I mentioned a couple minutes ago, the price of oil going up can have huge impact on inflation. So if inflation goes higher, this can definitely influence central banks. And what I mean by that is it might delay them from cutting interest rates, which it could lead to lower asset prices in terms of stock prices.
Well, hang on. So if they don't cut interest rates, or they maybe even increase interest rates, that has an impact on stocks.
Yeah, exactly.
For our listeners, stock prices often are impacted based on interest rate levels.
Yeah.
So the higher the interest rate, sometimes the lower the valuation. So that's what we're really speaking about here.
Exactly. And so further to that, the next trickle effect would be it can affect consumer prices for anywhere from gas prices at the pump when you're filling up your car to any transportation you're taking, flights, as well as just general prices, let's say in the grocery store, for example. And, higher prices like this affecting the daily consumer can slow down economic growth, which can potentially lead to stagflation, which is high inflation paired with a stagnant economy.
Yeah, so that's the ultimate worst case scenario that you often hear about. And the last time we really saw some stagflation was in the early 70s with the oil crisis back then, where we had massive amounts of inflation and growth was knocked completely flat.
Yeah.
While stagflation and all this sounds significant, and it is, it's not new, and nor does it mean that that's actually going to occur. I was reading the Wall Street Journal this morning, and there was a massive article about what economists think. Now, again, we don't build and manage portfolios based on predictions, but it is interesting that the vast majority of economists do not feel that there is a recession coming, even with everything going on. And I believe the numbers are something to the extent of 31% chance of a recession. Now, a month and a half ago, it was 27% chance of inflation. It hasn't really moved the needle in this particular junction, unless oil stays at a high level for a long period of time, which again is not expected to occur. Then economists, generally speaking, aren't necessarily worried about markets falling into slow growth or a recession.
Yep. They also expect the CPI, the Consumer Price Index, it will be up about 2.9% in December of 2026 from a year earlier. And in January, they expected it to be a slightly more modest 2.6. From before the conflict, they're now expecting a 2.9% inflation, which is 0.3% higher than before the conflict.
So, what we're really getting at here is the general economy underneath they don't feel like it will be dramatically affected unless we have a long-term oil issue.
Yeah, exactly.
Okay, so let's keep it going here, Jackson. Let's going to review now. We've got 19 conflicts, and we've got this report from the National Bank. It's a beautiful report which essentially highlights the last 19 military events going back to 1939, World War II.
Yeah, exactly. And so each geopolitical shock feels different and unique in the moment. There is, some underlying trends that we see in terms of how the markets have reacted in the past. So I'm looking at a table here that reviews 19 different geopolitical events, military events, so wars, and how the markets have reacted prior to the event, after the event, and what it looked like in terms of a returns perspective a year after, and certain averages that I'm going to explain. So on average, 12 months after each geopolitical event.
Actually, no, it's not geopolitical. It's a military conflict.
Military conflict, yeah. Markets have been up 5.7% on average 12 months after. And 67% of the time, markets have been positive 1 year after the military event, the war. Further to that, the max drawdown on average between all these 19 events have been 11.8% negative. So, sometimes obviously some wars have produced some more significant drawdowns, some negative 20% drawdowns, 23% drawdowns, but a lot of them have also produced negative 3% drawdowns, negative 4% drawdowns. So on average, they've been down minus 11.8%, not minus 20, minus 25. And so what we're seeing here as the underlying theme is that although there is conflicts occurring, what has typically prevailed has been the ability for corporations and human ingenuity to push forward through this and to essentially keep up with their corporate profits and their corporate earning powers.
You're absolutely right, Jackson. I'm looking at these lists. I've actually, as an advisor, I've lived through 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of the 19.
Yeah.
I'm kind of feeling a little bit aged here. So 10 out of the 19. And I remember being at MBA school when actually I was a bond trader, when Iraq invaded Kuwait and then we had the first U.S. conflict, first Gulf War. Yeah, that's when I can vividly remember. And then all the way through, for me, actually probably the most vivid memory of any conflict was when the airplanes hit the Twin Towers in New York City in 2001. I mean, that was unbelievable from a human emotion perspective. but I vividly remember it felt like the world had changed. And that was one of the periods that had a lot of volatility.
Yeah.
I remember getting on an airplane. I had to go to Europe for a conference 2 months after, and just this eerie feeling of being in airports because transportation from that point on had changed.
Yeah, I don't doubt it.
One of the things that I would comment on is if I look at this same chart where it's 1 week after the conflict, a month after the conflict, 3 months after the conflict, and 12 months after the conflict, going down these 19, there's a higher percentage of positive outcomes than there are negative outcomes.
Yeah.
And so it's just another reminder that, like you said, markets, economies are fairly resilient and get through these military events.
Yep, correct.
Okay, so we just finished a review of the evidence behind military conflicts, the last 19 military conflicts in almost 100 years.
Yeah.
Sometimes investors feel that it's smart to trade through. It's smart to actually sell stocks, go to cash, sell stocks, go to bonds, and then wait for calmer times. We're going to jump into this sort of next area, and it's really this idea of like, should investors try to trade through conflict?
Yeah.
So what are some general thoughts we have here, Jackson?
There's a couple things here. Obviously, people during these times of volatility might perceive opportunity in the markets to change from one asset class to another so that they can either reduce their risk or, spot an arbitrage moment.
And often it's based on an individual watching their investment account because it goes down, and then the next week it goes down, and it continues to go down, and they feel uncomfortable about that. And sometimes they feel that if I just sell, I'll feel better.
Yeah.
I'll stop the pain.
Yeah.
So that's just the human nature of this thinking of how do you deal with volatility.
Yeah, we have some overwhelming evidence against that. So we're looking at a Morningstar report table here. It reports the returns on different periods for tactical asset allocation versus a simple buy, hold, and rebalance strategy. So just to explain what tactical asset allocation is, or TAA, it's exactly like I just said, when people change asset classes from one to the other based on wanting to reduce risk, avoid volatility, or they perceive that they think there's an opportunity they can jump on.
Well, and hang on, these are tactical asset allocation strategies, right?
Yeah.
So these are professionally managed strategies
Yeah.
where they're trying to reduce risk, but also maximize the return. They're almost like hedge funds, but they're not hedge funds. They're opportunistic. They're trying to make the best return they possibly can.
Yeah. So this table here reports on returns based on professional managers who are tactical asset allocators. They manage a fund versus a professional managed buy, hold, and rebalance. It's a 60-40 compared to a 60-40 tactical asset allocation. And so over a 1, 3, 5, and 10 and 20-year period, every single period there is a significant underperformance on the tactical asset allocation funds, and they're anywhere from 280 basis points to 480 basis points.
So anywhere from 2.8% to 4%.
Yeah.
Said another way, I'm looking at the 10-year results here. If you had a buy, hold, rebalance portfolio, you generated 8.27%.
Yeah.
A tactical asset allocation generated 4.6. So you underperformed for 10 years, 3.67%, which is astronomical.
Yeah. And on the 20-year period, it's not much better. So the balanced fund, the buy, hold, rebalance, has a 7.81% return, and the TAA fund has a 4.97% return. So over a 20-year period, if you were to invest with those exact returns, $1, your $1 in a tactical asset allocation fund would grow to 2.64, and your $1 in a buy, hold, rebalance fund would grow to 4.49%. So the buy and hold and rebalance strategy, you're left after 20 years with approximately 70% more assets.
And that is massive. And so this is this indication of individuals tend to underestimate the impact of percent returns. But when you span that compounding over a long-term period, it is absolutely, 1% is massive, let alone 2 or 3%.
Yeah. And one more thing to mention, which is like a key caveat of this conversation, is during the time periods that we're reviewing for the tactical asset allocation, because during volatile periods, that's when a TAA fund is supposed to outperform because they spot the opportunities or they know when to pare back on risk.
Well, that's what human nature says. Human nature says, well, I need to own one of these strategies to get through difficult times or to manage my money better.
Yeah. But over that time period that we're reviewing, there were 9 different periods where there were significant market corrections, and that did not lead to any outperformance on the tactical asset allocation side.
Yeah. So we've got 9 distinct opportunities for professional money managers who feel that they can move money in and out of markets. We had 9 incredible opportunities, from the credit crisis to Greece defaulting to a variety, to COVID, to Russian-Ukraine war, to trade tensions last year. We had 9 of these massive events occur, and there was no value added by trading through it.
Yeah, exactly. One other thing worth mentioning, I'm looking at another table here. It's on the same topic, but I'm switching charts here. It's produced by Dimensional Fund Advisors. It's talking about the performance of the S&P TSX Composite from January 1977 to December of 2020. And the chart goes like this. It shows a growth of $1,000. You invest $1,000 in January 1977, and you let that grow to December 2020. If you were invested throughout the whole period, that $1,000 would grow to $63,000. But if you missed the one best day in the market, so if you tried to, get out of the market in a volatile period and get back in, but you missed that one best day, that $63,000 is now $57,000. And it shows now if you miss the 5 best single days, the 15 best single days, the 25 best days. And so if you missed the 15 single best days, that $63,000 now turns into $23,000. Now, the important part here, and this is super important, is those best days typically occur during the most volatile periods in the market. So what that means is usually markets correct sharply, but there might be a day in that volatile period where markets also bounce up by 5%. And those days are the best days I'm talking about, the 5, 10, 15 best days. So those are typically in extremely volatile periods. So you want to stay invested to be able to capture those upswings in the market.
That's well put. The implication of that research is that if you think you can trade through volatility, you might get that first trade, you might get out of the market, you might feel great because your portfolio is no longer moving around. But at the same time, once you're out, there's a very high chance you're going to miss the best day or the best couple of days. It reminds me of last year in the trade. What was the day, the special day? Liberation Day. Right around that period, there was some big days where the markets went down, and there was one day where the market bounced back up 8%.
Yeah.
And if you were not in that 8%, that is a big blow to your long-term returns.
Yeah.
So that's a very good point, Jackson. Okay, my final comment on tactical asset allocation is simply just kind of bringing it together with the history and evidence around volatility during wars. So you add the two together. We know that the volatility during wars typically is short term. We know that trading a portfolio, trying to be tactical, is not a good way to generate additional returns. You shouldn't be putting the two together. And so that's one of the big messages in today's episode for our listeners. We're gearing up for the end here, Jackson, and let's talk about long-term perspective. We often talk about making sure individuals keep a very long-term perspective when it comes to investing. But what are the implications or the comments you'd like to add at this point?
Yeah, I mean, right now we're seeing a lot of short-term changes in the marketplace, but I think it's really important when looking at investing and looking at your financial plan to think long-term, because that's when the real difference comes into play. So it's very important to have a plan, to have the right asset allocation in your portfolio that you could stick to long-term throughout these periods, and to really focus on the things that matter, such as your spending habits, your saving habits, and your emotions. So if you can control those things, you're more likely to have a successful long-term investment journey.
That's fantastic. So that's essentially your takeaway.
That's my takeaway.
Okay, great. I think it's a great takeaway. I mean, the investment philosophy is the most important thing. And if you have a philosophy, you use your philosophy to help you get through difficult times, sometimes emotional times or volatile times. We're in one of those periods right now. On a slightly lighter note, I've had clients come up and say one of their favorite quotes that they've picked up on these podcasts has been something to the extent of a portfolio is like a bar of soap. The more you touch it, the smaller it gets. And I had a client tell me that just last week. So to our clients, one of the messages I'd like to say is, congratulations for staying the course through all these different years. Our phones are not ringing off the hook right now. I don't know, Jackson, do you have a lot of clients calling in?
No, they're staying in their seat. They're staying disciplined. They're staying smart about their long-term plan. And I think that's what's important.
Yeah, and they may have questions, and we're here to answer their questions.
Absolutely.
For individuals who are not clients, good luck with your investment experience. Stay the course, stay long-term. Diversify well across multiple asset classes, and in periods of negative drawdowns, add money to your portfolio if you can. So Jackson, thank you so much. We've done our first father-son episode. It's fantastic.
Yeah.
I know you've got a great podcast voice, and we get a lot of good comments on that. And to our listeners, thank you so much for tuning in. Good luck with everything, and we'll see you in the next episode.
Thanks.
Thanks for listening to the Empowered Investor Podcast, brought to you by Tulette Matthews and Associates. If you've enjoyed today's episode, be sure to follow or subscribe and share it with somebody who wants to invest with clarity and confidence. To learn more about how we help investors build lasting financial peace of mind, visit us at tma-invest.com. Until next time, stay informed, stay empowered, and stay on track to your financial goals. Investment and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use their best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.